Hi, everyone. Welcome to Cushman Wakefield Asia Pacific Capital Markets webinar with a spotlight on supply chain management. I'm Catherine Chen, Director of Asia Pacific Capital Markets Research based in Hong Kong. Last year, the Asia Pacific region saw a record high level of commercial real estate investment totaling over $200 billion, a 25% increase from the previous year. In addition, we saw record high levels of capital flowing into the logistics sector. In this webinar, we are going to discuss the key investment trends and outlook, as well as supply chain network in Asia Pacific. First of all, I'd like to introduce our wonderful speakers today. We are pleased to have Kevin Lee joining us from DHL Supply Chain. Kevin is currently the head of real estate solutions in Asia Pacific with over 30 years of experience in real estate. Kevin has in-depth experience in asset and land acquisition, development, and portfolio management across major markets in Asia Pacific. Kevin is also joined by our industry experts at Cushman and Wakefield. Tim Foster, our head of supply chain and logistics advisory, is going to take us through the key challenges and opportunities surrounding supply chain management in Asia Pacific. Tim has over 20 years of experience in supply chain and logistics strategy, design, transformation, and optimization. He has also operated across diverse markets, including China, North Asia, Southeast Asia, India, Australia, New Zealand, Middle East, Africa, and Europe. After Tim's presentation, we're going to have our panel discussion on Asia Pacific investment trends, as well as supply chain management. Our panelists today include Kevin Lee from DHL, whom I just introduced, and Dennis Yao, Head of Investor Services for Asia Pacific at Cushman and Wakefield. Dennis has over 30 years of experience in industrial and logistics investment, corporate real estate transactions, as well as REIT advisory in Asia Pacific. Last but not the least, Gordon Marsden, who sits in our regional APAC capital markets platform and for the last 14 years has been based in Hong Kong. Today, he's joining us from Singapore, having temporarily escaped from the COVID tightening in Hong Kong. Gordon primarily works with global, regional, and cross-border investors and supports our teams on major divestment mandates across the region. Now, let's first take a look at the Asia Pacific investment activity in 2021. According to data from RCA, 2021 was a record year for commercial real estate investment in Asia Pacific, as the total transaction volume reached an all-time high, exceeding $200 billion. Growth was seen across almost all sectors and in most Asia Pacific regions. Mainland China, despite the tightening of its real estate lending policies, continued to witness growth and recorded the highest transaction volume across all Asia-Pacific markets. Investment in China was largely driven by strong demand from end users, SOEs, as well as institutional investors. Australia also recorded one of the highest growth in transaction volume last year, with several large office deals and logistic portfolio deals being completed. Australia also overtook Japan as the largest cross-border investment destination in Asia Pacific in 2021, with a record level of nearly $16 billion of overseas investment, accounting for 40% of its total investment volume. Being the largest English-speaking country in Asia Pacific, Australia benefits from a high degree of market transparency, typically long lease terms, and comparatively higher cap rates for mature markets. Third on the list is Japan, which saw its investment volume slightly softened last year with lower levels of overseas investment, especially from the US. Nevertheless, Japan's J-REIT market remained extremely active, and international investors' appetite for Japan's multifamily sector remained very strong. It's estimated that Japan's multifamily market represented over 80% of the available stock in Asia Pacific and is currently the largest and most mature multifamily market in the region. South Korea continued to perform strongly in 2021, driven by aggressive local buyers. At city level, Seoul was the largest market by investment volume among all Asia-Pacific cities. It's worth mentioning that South Korea was the only major market in Asia-Pacific that recorded a year of growth during the worst pandemic time in 2020. Since then, the South Korea market snowballed with rising pricing levels in almost all sectors, further pumping up its total transaction volume. We saw average Grade A office pricing in Seoul CBD rose by over 30% since the onset of COVID, and similar growth patterns are witnessed in the other property sectors, especially logistics centers. Average logistics cap rate in South Korea has been steadily declining over the past 5 years and now sitting at record low in the range of high 3s to low 4s. Hong Kong was also among the top 5 most active markets in Asia Pacific last year, although by a quite far distance. The makeup of Hong Kong's investment markets has changed in a way that fewer large portfolio deals or high-value deals were transacted. Instead, last year we saw many smaller, lower-value deals being changed hands. In industrial deals, including logistics centers and data centers, are now investors' top choice in Hong Kong, whereas hotels has also emerged as an alternative asset class. Next to Hong Kong is Singapore, which has been increasingly popular given the stark contrast between Hong Kong and Singapore's travel restriction policies, making Singapore more appealing to international investors and occupiers. According to our latest forecast, Singapore is expected to see the highest office rental growth in Asia Pacific this year at around 4%. Logistics rentals in Singapore have also been steadily increasing in the recent months. The last two on the list are Taiwan and India. Taiwan's investment market has been quite active for the past 2 years, driven by local investors and end users. India, on the other hand, saw investment volume down by 46% last year, but we expect India's investment activity to pick up this year as the economy recovers. Now let's take a look at cross-border investment in Asia Pacific. Within the region, Singapore and Hong Kong are the two largest sources of cross-border capital, and not surprisingly, they're both targeting at Australia and mainland China. Although Australia is partly driven by the joint purchase of Milestone portfolio by GIC and ESR. GIC was the most active Singaporean capital in overseas investment last year and also very active in joint venture purchases. Other active Singaporean investors included CapitaLand, Mapletree, and CDL. For Hong Kong-based investors, aside from ESR, who also recently acquired Singaporean asset manager ARA, the majority of Hong Kong-based investors were focusing on the mainland China market. For instance, HKMA acquired two office projects in Beijing, and Link REIT purchased 2 retail malls and another 2 distribution centers in mainland China. Outside Asia Pacific, US and Canada were the 2 most active overseas investors. For US investors, their top pick is still Japan, although the number has come down slightly from the year before. In contrast, investors from the US expanded their investment in Australia, especially for office and industrial projects. On the other hand, Canadian investors have been scaling down their investment in the US while increasing their overseas allocation to Asia Pacific, especially to growth markets like China and India. And interestingly, office and retail were the 2 largest invested sectors by Canadian capital over the last 2 years. Now let's take a look at transaction volume by sector. As mentioned earlier, almost all sectors have witnessed growth in transaction volume last year. By proportion, the share of office investment dropped by 5 percentage points, replaced by an increase in industrial and retail investment. Nonetheless, office investment still took the lion's share at 43%, with a total investment volume of $88 billion. Demand for office towers in large gateway cities such as Beijing, Shanghai, Tokyo, Seoul, Singapore, and Sydney still remain very strong. For retail, it's a mix of CBD shopping centers, community malls, as well as a few department stores. We saw retail investment recovering in all 5 major markets, which are mainland China, Hong Kong, South Korea, Japan, and Australia. The booming sector is, of course, in industrial, which includes a wide range of new economy assets such as logistics, data centers, and life science parks, which have all benefited from the recent change in lifestyle. Total industrial investment reached a record high at $55 billion last year, and we expect this to continue to grow this year for reasons that we will see on the next page. So this slide here shows capital raising activity globally and also in Asia Pacific. The first chart on the left, we can see the amount of global capital raising being had recovered last year, although the number of funds was reduced, implying that there are a smaller number of funds in the market, but the average fund size has increased. More importantly is the chart in the middle, which shows industrial-focused fundraising had reached a record high in 2021, with tremendous growth seen since 2019. Within the industrial fund pool, the amount of logistics fund with an Asia-Pacific focus has exceeded all the other regions. In addition, most large logistic funds with an Asia-Pacific focus are targeting at China and Japan. Next, let's take a look at peer global survey. When investors are asked how will they approach their investment strategy in 2022, healthcare, digital real estate, assuming it means data centers, and industrial are the top 3 picks for global investors in terms of increasing investment for the sector. On the other end of the spectrum, many indicated that they are going to invest less in office and retail. What this means is not that people no longer buy office or retail, but the allocation to office and retail may drop and to be replaced by increasing investment in alternative sectors such as healthcare and data centers. Next, my final slide on 2022 investment strategies. We can see from the chart on the left that the majority of the funds are targeting at value add and opportunistic investment, while core strategy only represents a fraction of the total capital being raised. One reason may be that there are simply not enough core opportunity in the market, especially in Asia Pacific. Many investors, especially global investors, are targeting at the region's high growth markets. In conclusion, what to buy in 2022? For office, despite the scarcity of tradable stock for core assets, we think prime office buildings in major gateway cities still remain high in demand, especially after travel and social restrictions are lifted or relaxed. Recent transactions also demonstrate resilience in prime office pricing in many gateway cities. In mainland China, investors may also find pre-distressed opportunities as some indebted local developers selling off their commercial projects to fund residential development. Investors who seek higher returns are also encouraged to think creatively in repositioning assets to meet the growing demand for flight to quality and rising ESG requirements. For industrial investment, partnering with local developers, especially those with land banks, could help unlock new opportunities. especially for data centers and logistics development. In addition, build-to-suit opportunities exist across the region as occupiers seek to diversify risk in their supply chains. For retail, CBD shopping centers and neighborhood malls have shown their defensive qualities, especially those that are smaller in size. In addition, growth markets like China, India, and Southeast Asia still remain underserved by physical retail space, and longer-term opportunities in these markets should not be ignored. For hotel, we think there may be opportunities in post-COVID rebound destinations such as Singapore and Sydney, as well as opportunities for conversions. In Hong Kong, we've seen many examples of hotel conversions to residential, service apartment, or office space in the last year. With that, I will now hand over to Tim to talk about supply chain management in Asia Pacific.
Thank you, Catherine, and thanks to those attending this session. As Catherine highlighted, the logistics and industrial sector is experiencing really strong growth. Obviously, a lot has been written and spoken about the high demand for e-commerce fulfillment infrastructure. So I'm going to focus more on factors in play that indicate the real estate investment opportunities in logistics and industrial assets are broader based than just e-commerce and reach back further up into supply chains. I'm going to come at this from the perspective of the occupiers, the supply chain managers. These are the customers that drive demand for logistics and industrial assets. And it's important for investors to understand what occupiers are thinking and what they're doing in relation to their supply chains. Supply chain disruption is occurring on a scale we have not seen before due to the volatile customer demand profiles, material supply and labour shortages and transport constraints. Moody's stress index indicates some easing in China and the US. I should note that this measurement is before taking into account any impact of conflict in Ukraine. Despite some easing, I expect the challenging supply chain conditions to last at least for the next 12 months for supply chain managers. Companies are reporting material impacts on growth and earnings performance, bringing supply chain management into sharp focus for executives, boards, and investors. In my opinion, this is a positive development. Supply chain management is no longer seen as a back office function, but has been shown to add real value. Supply chain teams are now focused on securing materials and products, hiring enough labour to keep manufacturing plants operating and warehouses as well, and securing transport capacity so they can meet surging customer demand. Inventory planning teams are leveraging the relationships they have with their suppliers to secure raw materials and finished goods when they can. Resulting in an immediate demand for additional warehouse storage space. I see this demand being relatively short term as more nuanced inventory management practices will be needed. I don't necessarily subscribe to the view that JIT inventory management is dead. Customers and internal finance teams will ensure pressure is on to manage working capital and with it inventories. And in my experience, one of the first categories to come under the cost-cutting spotlight is excess storage. So just a watch point there. Given the disruption to supply chains, we see strong moves to leverage any excess manufacturing capacity in markets across Asia Pacific. And there is now more urgency for companies to action their alternative supply strategies. We might call this Asia for Asia strategy. And what do I mean by that? Notwithstanding the current disruption, when it comes to shaping supply chains in the region, there are underlying megatrends at play. Worldwide, global trade peaked around 2012. Global trade is still growing in absolute terms, but the share of output moving across regional borders has fallen from 28% in 2007 to 22.5% in 2017. According to the Brookings Institute, this trend is strongest in Asia and is due to the growth of Asia's middle income earners, projected to reach from 2 billion people in 2020 to 3.5 billion in 2030. By 2030, the developing world outside China will account for 35% of global consumption, with India, Thailand, Malaysia, and the Philippines leading the way. Along with growing demand markets, urbanization has driven spending on logistics infrastructure, upgrading of ports, roads, and rail systems. This investment is strongest in Thailand, Vietnam, and the Philippines, according to the World Bank. As a result, logistics costs are falling. In Indonesia, for example, the cost of logistics as a percentage of GDP has fallen from 27% in 2015 to 22% in 2020 and will reach 19% by 2024. The effect of growing middle income earners and infrastructure investment is powering intra-region trade across Asia Pacific. More and more products that are produced in Asia are now being consumed in Asia, what we call Asia for Asia. The data clearly shows an increase in the value of products produced in Asia, flowing to markets in the region, and a relative decline in goods flowing out to other regions. Companies are moving to optimize their supply chains to service growing demand, and this will power the build out of logistics and industrial real estate in Asia Pacific well into this decade. ESG is another significant factor shaping supply chains. Consumers and investors are rewarding companies perceived to be better for the environment. Holding on to consumers and securing capital are great motivators for occupiers to initiate change. Supply chains are the most significant contributor to a company's carbon footprint. Typically, for a consumer products company, the supply chain accounts for more than 80% of that company's total greenhouse gas emissions. Business leaders are beginning to understand that reducing supply chain carbon emissions is a crucial enabler to achieving aggressive but necessary corporate ESG targets. When asked if sustainability will become a core responsibility for supply chain professionals, 98% of respondents answered yes in an MIT study. Actions to reduce carbon emissions will be driven very much by supply chain leadership and executed at the planning and operational levels. Decisions about the optimization and build out of supply chain networks made today have a life of sometimes 5, even 10 years plus. Again, to be clear, today's decisions will need to deliver on achieving carbon emission targets over the coming decade. And we will be living in a very different world over that time frame. A further ESG-related development is the design of circular supply chains that are becoming a part of doing business across many industries and markets. For example, in consumer electronics, fashion, and even tires. These circular supply chains are based on new business models. They require new logistics infrastructure and in themselves will create investment opportunities. Increasing demand from within Asia leads to the build out and optimization of supply chain networks. Occupiers need to start making customer service and financial trade-offs that also include impact on the environment and embrace the achievement of ESG targets. Supply chains will need to be responsive to their customer needs and expectations, and locating facilities and inventory in close proximity to growing consumer demand markets will be crucial in achieving this. Cushman and Wakefield's Manufacturing Risk Index, compiled last year, identified that 4 of the top 11 markets in the upper quartile for competitiveness are in Southeast Asia, plus India. The fact that manufacturing capacity in a market like China is increasingly being deployed to satisfy growing domestic demand creates opportunities for other markets as alternative sourcing locations. This includes Thailand, Malaysia, Vietnam, the Philippines, Indonesia, and India. Supply chain teams are under internal pressure to find alternative sourcing locations due to disruption, geopolitical tension, and rising costs. And customers are asking for access to alternative supply sources. Taking one industry example, the production of technology products. This will grow in Asia, high-tech, automotive, consumer electronics, all experiencing increasing demand in Asia. Manufacturing capacity in China is being directed towards servicing growing domestic demand, and markets like Thailand and Malaysia are therefore well placed to pick up new investment in advanced manufacturing capacity and capability. The manufacture of components and sub-assemblies that go into technology products will increase in markets like Vietnam, Indonesia, and India. These markets will also look to move up the value chain and begin producing more finished goods to service the growing demand. So some critical decisions are being taken about the location of manufacturing and distribution facilities to satisfy growing demand. When designing supply chain networks, occupiers need to bear in mind that 80% of the cost of a supply chain is determined at the design stage. So these are critical decisions that must be data-driven and fact-based. Supply chain network optimization is an analytical process to determine the unique configuration of manufacturing and distribution facilities, inventory flows, and transportation modes that achieve the desired customer satisfaction level at the lowest cost and now lowest carbon footprint. When we run these optimization processes for our clients, we typically see substantial customer service improvements, reduced logistics costs of between 5 and 20%, and inventory reductions of between 10 and 40%. Further, the optimized supply chain configuration determines the logistics and industrial real estate requirements needed and the implementation roadmap to execute on that configuration, starting with the types and location of manufacturing and distribution facilities. Along with the supply chain build-out, demand is high for modern spec facilities and developments that address the need for speed and efficiency and have built-in sustainability features. Facility design from the operations out, taking account of business needs, capacities, processes, automation, and technology, will be followed by the building specification, including height, spans, flooring, and utilities and services, not the other way around. So to summarize, occupiers operating in Asia Pacific are making some big calls about their supply chains, and real estate investors need to stay close to these developments and understand how supply chains are being shaped. The focus on building supply chain resilience is creating an immediate demand for logistics space. Occupiers also seek to leverage their existing networks in different locations and reduce complexity in their supply chains by rationalizing product ranges. Due to rising middle income levels and infrastructure investment, growth in intra-regional trade will power demand for logistics and industrial real estate. Asia for Asia supply chain networks. ESG. Consumers and investors demand action on the environment, specifically carbon emissions. As supply chain leadership takes responsibility for achieving ESG targets, We'll see this factored into longer-term decisions on supply chain design, including trade-offs around carbon emissions. Proximity to large and growing demand markets will see logistics and industrial assets built close to customers, supported by modern infrastructure and transport networks. Again, 80% of the costs in a supply chain are locked in at the design stage, requiring fact-based, data-driven decision-making. And finally, along with the decisions about location of facilities, the specification of logistics assets will underpin demand for modern developments that support business needs and consider the expanding role of automation and technology in supply chains as the need for responsiveness and agility increases. In conclusion, the logistics and industrial real estate sector is experiencing strong growth, and we see that momentum continuing due to the underlying factors that are shaping supply chains in Asia Pacific. Thank you for your time, and I'll now pass back to Catherine.
Thank you, Tim, for sharing your thoughts on supply chain management. Now is our panel discussion time. Please click on the Q&A icon at the top right corner of your screen to submit your questions. The first question I've received is for Kevin. So can you talk about these supply chain challenges that you have faced since the onset of COVID-19, and how did you overcome them?
Thank you, Catherine. Yeah, I think with regards to the challenges that we've faced since COVID, I think it is fair to say that one of the biggest challenges in terms of cost, as we experience rising costs across all expenses in freight, transportation, real estate rentals, and also manpower. But in terms of the space costs, how we overcome this challenge is really from the onset, we have a very strategic logistic operations in all the major markets that we work on. So that means that we have a good network of fulfillment center and also regional distribution centers across Asia Pacific. So, but of course, we maintain good and healthy relationship with the landlord as well. That helps us to manage and overcome the challenges that we face during the COVID time.
Thank you, Kevin. Dennis, how about other investors or operators around the region? What have you observed as their responses to supply chain disruption challenges?
Thank you, Catherine. Well, firstly, I must say that it is not easy, and most landlords would take advantage of the situation to charge more. However, long-term investors in the space would take a different position to align with their tenants, with their customers. This is where I think scale is very important for investment in logistics. With scale, the investors could work closely with their tenants in solving some of the supply chain challenges, right? For example, it may be due to disruption, due to congestion. They could then start to plan a distribution site if the investors do have scale and be able to develop a new distribution point for the tenants, right? And today it may be disruption challenges due to pandemic, but in the future it will be something else. It could be geopolitical, as we are speaking now, And it's also important that investors understand their customers' business, and that is changing too, right? And then the investors must then be flexible, right? So with scale, you can actually have a bit more flexibility in service, in so-called serving the tenants, who are your customers. It is also important to understand that supply chain network of your tenants are critical to your business, right? And like I mentioned, that is changing, and how these supply chain are being disrupted, right? It could be due to pandemic, due to geopolitical situation. So which is why it's important that, we have Tim spoke earlier, that even for investors alike, supply chain advisory should also serve the investor community well, right? In the sense that you understand what your tenants want, and that you can actually plan to future-proof your investment portfolio, right? Your logistic investment portfolio. So in that sense, you know, portfolio management is no longer just about rents, collections, and property management. You know, the big challenge next, I would see as well, and for this, you know, investors, owners really need to work with the tenants. The big challenge will actually be ESG, sustainability. You know, how would your asset portfolio handle the ESG goals of your tenants, right? And with scale and hence flexibility, I would add, you can work better with your tenants to solve some of these issues and challenges. Thank you, Catherine.
I see. Thank you very much, Dennis. The next question is about China. So maybe Gordon, you can help answer this one. So China had some supply chain disruption last year. Have you seen any immediate impact on China's logistic markets in terms of occupancy rate and rental levels?
Thank you, Catherine. I guess first of all, looking at those reasons for the disruption, lots of thoughts from both Tim, sort of Kenneth, and Dennis sort of so far on that: materials, labour, transport availability and cost, COVID, and obviously a big one that has impacted China and will impact the rest of the region as well is energy costs. And you know, we are anticipating that some of those pressures will persist as we move forward. But of course, we're also sort of seeing the government sort of stepping in to sort of mitigate in areas like the sort of energy costs. So, you know, releasing coal reserves or indeed sort of committing to an increase in production. I mean, China is still, from a logistics market standpoint, a development market. Most major sort of cities and locations where logistics are concentrated, they're still going to see 20 to 40% growth in their supply during the period 2022 to 2024, so over the next sort of 3 years. So inevitably we are going to see some, you know, vacancy come through in different parts of the market as some of that stock comes online. And we've also got some quite different regional disparities within China. So as little as sort of 6.8% on aggregate vacancy in the South China market today, through to as high as sort of 20%, 20.3% in sort of Southwest sort of China. So, you know, hard to sort of attribute it directly to sort of supply chain disruption. And then on the sort of the rental side of things, again, you know, difficult to specifically attribute it to sort of supply chain. But in terms of what is happening, you know, we have seen over the last sort of 3 years a continued rental escalation in parts of China like South China, including the GBA. Stable to rising in most parts of sort of East China. We have seen a bit of pressure as we look towards sort of North China and sort of Central China. But as I say, tough to attribute that to, you know, the near-term supply disruption that we have seen in some of the markets. Back to you, Catherine.
Thank you, Gordon. So back to Kevin on asset management. As both an owner and operator, how do you achieve the highest and best use of DHL logistics centers?
Yeah, that's a good question, Catherine. I think from a DHL perspective, I think it's all about right sizing our logistic portfolio to our projected business volume. Like what Dennis mentioned, size does matter. So because we operate quite a fairly large footprint across Asia Pacific, we are able to do that to give a very optimal solutions and in terms of our business needs and the space planning. And on top of that, I think we believe in designing the logistics center with a very efficient layout, and increasingly we are future-proofing our design as well. be as all can appreciate, because we are really the supply chain people. So we know we have the in-depth and knowledge to design what we want, and therefore we do right size, we do efficient layout, and be able to future-proof our space. So that helps us to make sure that we maximize the use of all our logistics facilities across all the major markets to achieve the highest and best use. And ideally, given the COVID situation and also all unforeseen happenings that is affecting the demand for space, we believe that we need all our warehouse to be scalable. So that's something that is always in our planning when we design any new facilities in all the major markets. Thank you.
Thank you, Kevin. How about the latest technology that you have adopted? How about are they in terms of increasing the efficiency of DHL warehouse operations?
Yeah, we do. For DHL we have spent even before COVID, we have always been lobbying to push very hard into innovations in a solution to our customers. So we implement a lot of automation and robotics solution to our customers. But I think COVID simply speed up the need to implement this solution across all our operations, and that works for our customers because, as you know, during COVID time, there's in most country there's a severe shortage of manpower because of lockdown, because of the warehouse workers are falling sick. So that is something that from a supply chain perspective, we have been rolling out a lot of robotic solutions, especially in countries where there's a very tight tight supply and high labor cost, which make a lot of sense to implement robotic solutions to help any unforeseen situation happening in the warehouse operations. And one thing that is really interesting to really consider is really to tap on the 5G network to help us in terms of automation and all the signaling within the warehouse operations. But of course, the technology in 5G is not stable in most of the major markets. So we do hope that that would be something that we can look out for in the future.
Thank you, Kevin. The next question I see is about logistics yield. So I'm going to ask Dennis this one. So as cap rates for logistic assets are now near record low, do you think it's still a good time to invest in logistics, and how should investors maximize returns?
Well, while cap rates and yields are at record low levels, logistics and industrial continue to be good investment assets, really because of growth, right? Growth in the size of the market and demand, and as well as growth in the rents, right? People are consuming more and demanding better service and quality of products, right? So as a result, rents can never stay at these low levels. If you look at India, which is a great example, right? Some years ago, nobody would pay for a decent warehouse. Rents were so low because goods are stored in their houses, in the backyard, covered by sheets in the open yard, But now, with the improvement of the people's income, with consumers and international companies entering into the market, they can no longer accept that standard of storage and care of the products, right? So now you can see good quality warehouses being built and being paid for, being rented, for the likes of Flipkart, Snapdeal, and even Amazon, right? So rents may still be relatively low now. I'm talking about India, but they are under pressure to increase, right? To rise. So to be fair, it's not merely the quality of the warehouse that I've just mentioned. It's also the ability to improve the productivity of the warehouses. Very much like what Kevin said earlier, right? When you actually adopt a best practice, adopt international standards and use the best quality, have good advice, you know, you actually improve your warehouse design to then allow you to be able to pay more, you know, for quality warehouses, because you're able to store the products better, you're able to move the goods faster. Okay, this is where I think, you know, like Tim mentioned earlier, where warehouse design come in, right, to improve the productivity and hence the rent, right? The next level up, I would imagine, will be the more efficient and productive warehouse with ESG features, with sustainability features. And this is the next level where you will see rent continue to then move along with the improvement in your warehouse investments. Okay, so I would say that, you know, logistic assets continue to be a viable investment class, you know, and rental rates will rise for all markets, and that's really without a question. Okay, right now, I think investors are buying ahead of this increase. They are buying at super low yield, but with expectation that the yield will actually improve for them. You know, as we get better design building, as they build in more better features, and as the market comes to the level of rent payment.
Thank you, Dennis. So looking ahead, which markets in Asia Pacific do you think will see the highest growth in logistics demand?
Well, actually, I mentioned earlier that really the few indicators and demand drivers, and they are population, okay, including the rise of the middle income, as well as you look at potential of growth. Then you have to look at the existing infrastructure, right, as well as the current supply. You know, what's the potential for that to improve? And then what's the potential of growth of the asset class, right? So I would say India and China, because they are really, really big market, you know, and big market because of population, rising middle class, you know, huge demand for products and goods, you know, and India in particular are some years behind China in terms of infrastructure development. So there's a lot more investment to be put in that area, right? Southeast Asia will be countries like Indonesia and Vietnam. Again, the same few factors that I mentioned about demand factors, you know, and for Asia Pacific on a whole, China, Australia, Japan, Korea all have huge potential, you know, but these four countries, China, Australia, Japan, Korea, and to a certain limited extent, Singapore will lead with quality and sustainability and ESG upgrades, right? India and most of Southeast Asia countries, like I mentioned earlier, Indonesia, Vietnam, Thailand, will be in supply overdrive, right? That means they will build in the supply, because right now the supply is not enough to meet the demand, you know, in terms of standard quality warehouse space. Not up to the level of the China, Australia, Japan, Korea yet, but they are quality warehouses. So there will be vast improvements in their infrastructure, including roads, rails, and ports. So this is really the take, you know, the whole Asia Pacific is actually in a rhythm of growth, in a different rhythm of growth.
Definitely.
I had to put it. Yeah.
Thank you, Dennis, for your answer. So the next question is on investment strategy. So I will ask Gordon this one. What strategy should investors adopt on logistics investment going forward? What's your recommendation?
Thank you, Catherine. I mean, Dennis has covered off some great points. I guess ahead of what should they be doing, you know, maybe a quick look at what they are doing. So as we've got to the end of sort of 2021 and started 2022, you know, some reports have come out around the largest, be they capital raising or, you know, deployments globally, and sort of interesting to sort of look at those. So on the top 10 logistics funds raised in 2021, two of those, three of the top five are, you know, Asia Pacific focused. Two are in the value add and one is in the opportunistic kind of arena. So that perhaps sort of suggests where, capital is being raised for still that sort of development end of the spectrum. And then there was two major sort of deployments that also sort of feature in the top 10 globally. One of those was made to a Japan logistics initiative. Another one was made to a China logistics initiative, both development in sort of orientation. So, still huge amounts of capital being raised and deployed into development across the region, many of the geographies that Dennis has just spoken to. So I guess then that sort of turns the question to, what about all of this sort of completed development? And, as assets become increasingly stabilized, they're increasingly finding, homes amongst, a mix. So, we've seen, in China, the sort of C-REIT sort of pilots, mostly in infrastructure, but, one portfolio that is exclusively logistics real estate. We've seen participation across the region by the regional open-ended core and core plus funds, and a few larger scale institutionally backed closed-ended platforms as well. We've also seen sort of REIT participation. Catherine, you mentioned earlier on that Link REIT have participated into sort of distribution assets, and that's the sort of the first time that they've played in that sector. So we are sort of seeing exit opportunities for the product that is being developed, and we're seeing plenty of capital also happy with the returns at more that sort of core plus type level as well. And then we're seeing the operators and owners that are developers also taking their skill sets and using those for the benefit of long-term holds. So there's been a lot of discussion so far around that collaboration with your landlord, the significance of scale, about it being a close-knit relationship between a landlord and a tenant. And so we've sort of seen transactions like the one we've just been involved in China, where DLJ selling a portfolio of logistics assets to ESR, backed in that instance by sort of GIC. So we're seeing those experience groups like ESR continue to be involved in the long-term hold of real estate in the logistics sector. So really sort of interesting. So that's a little bit kind of a look back at what they have done. In terms of what they should be doing, I guess it's more of the same. And then it also goes back to the geographical focus that Dennis talked about in his earlier sort of answer. And back to you, Catherine.
Thank you, Gordon. How about data centers and life science parks? What's your observation on the growth and return of these two sectors as they're increasingly becoming popular?
So they might make use of the same industrial land type as logistics, or as light manufacturing and the traditional industrial as we know it. But that's probably kind of where the similarities stop. I mean, if you think about the drivers of logistics, and Tim's spoken about these: consumer spending power, e-commerce, food safety, food security, medicines, something that's sprung to prominence. I mean, if you look at data centers, it's a very different list. The internet of things, big data, AI, machine learning. And then if you were to look at the sort of what is driving sort of life sciences and utilization of lab space, well, obviously sort of a reaction to COVID, but I would otherwise say two key attributes would be around where is the talent, and then also the synergies and proximities to other sort of like-minded organizations. So yeah, fundamentally they may well be using the same underlying type of land, i.e. industrial land, but at that point the similarities really begin to sort of diverge. And they diverge further when you then start considering around the cost base for each of these sort of asset classes. So, you know, a basic logistics single story shed through to something that is multi-level, obviously enhanced costs associated with that. Maybe you're then incorporating cold chain sort of storage, and you know the power that is required and the additional M&E. So that's a sort of a cost again, but you've then probably got a massive leap up towards, as I say, delivering you know, life sciences or lab space, which is enhanced office, maybe even. And you know, if you are trying to pursue that sort of talent, are you also having to offer much more amenity? We're just beginning to hear about logistics players incorporating amenity into their facilities, daycare centres, those sorts of things. But you know, I'd sort of say that as you are trying to attract talent into the life sciences and lab type space, that's probably even more relevant and important today. And then you go a step again in terms of the cost infrastructure to deliver data centers. So, you know, that, you know, is vastly different. With that, you then obviously think about different procurement methods, different ways of collaborating with expertise and with talent. And, you know, you then begin to think about a very different sort of leasing strategy and moving away from maybe an acceptance of a 3-year lease on a logistics warehouse through to data center operators and providers that want as much as you can possibly offer. Is that and perhaps that is constrained by regulations in markets at the moment, but is it 10 plus 10 plus 10, really trying to get a very long-term commitment. So look, I mean, all areas are growing, but they are, aside from perhaps the kind of the original use of land, they diverge pretty quickly in terms of the growth, the return, and indeed how investors need to approach each of these sectors. Back to you, Catherine.
I see. Thank you, Gordon. I see there are only 3 minutes left, so I will ask one final question to Kevin on ESG. So becoming carbon neutral is now a goal for many real estate investors. At DHL, what actions are you taking to achieve your zero emission target?
Right. Yeah, with regard to ESG, I think as a global supply chain company, we do have a very strong corporate mandate to be ESG focused, as we believe that effective ESG program will basically help us to manage risk better, improve efficiency, and reduce costs, and maintain a strong stakeholders relationship, and so that to allow us to build more valuable, competitive, and sustainable operations within the group. So what do we do on the ground? I think from a real estate perspective, going forward, facilities that we develop, we have the mandate that we need the facilities to be really carbon neutrals for our operations. But then this is only part of that. Reducing carbon footprint, as all you know, warehousing is only emits a small percentage of the CO2s, but we are also looking at how do we reduce the CO2 emission in terms of the transportation network as well. So that's why you can read from the media's news that we are actually implementing a lot of electric trucks and all that progressively in all the countries across the globe. So this is what it is something pretty challenging, but I think we are very clear that we are going for full steam in terms of the ESG targets. And inside the warehouse, we are also looking at how we can improve the staff wellness features as well. This can be a very small, minute details in the warehouse designing at the onset, but I think from a company point of view, we believe in creating a very pleasant and a very secure and safe environment for our staff to work in, so that this will help basically to drive a higher productivity in our operations. So yes, I think ESG is really important, and what Tim has highlighted earlier is key for us. And we do want to work with partners, including landlords and investors, that have a strong ESG mandate as well, so that will goes very well and meet our corporate objective.
Thank you, Kevin.
Catherine. Yeah.
Thank you. Or so maybe we can do ESG on our next webinar.
No problem.
Yeah. Thanks again, Kevin, Dennis, Gordon, and Tim for sharing your insight today. We also have just released a report on the role of Asia Pacific in global supply chains. If you haven't received a copy or wish to subscribe for our Asia Pacific investor and developer newsfeed, please drop myself or any of our colleagues an email. Thank you very much for listening. Keep in contact, and we look forward to engaging with you again soon. Have a great day ahead. Goodbye.
Bye. Thank you.